Short selling is often described as a necessary part of healthy markets, a way to expose fraud, correct overvaluation, and keep companies honest. But critics argue that in certain situations, short selling does something very different. They say that when short interest becomes extreme, and when negative narratives are amplified through research reports, media coverage, and market mechanics, short selling can accelerate a company's collapse, sometimes regardless of its underlying business. This video examines how that process works and why companies like Overstock, GameStop, Nikola, MMAT, and the MMTLP spin-off, NextBridge Hydrocarbons, are frequently cited by investors as examples. At its core, short selling is simple. An investor borrows shares of a company, sells them on the open market, and hopes to buy them back later at a lower price. The difference becomes the profit. In theory, short selling serves an important role. It allows investors to express skepticism, identify overvalued companies, and surface real problems. Many frauds have been exposed by short sellers. But critics argue that problems arise when short selling stops being a hedge and becomes a strategy built around sustained price destruction. Here's where the concern begins. High short interest creates constant selling pressure. Falling prices reduce investor confidence. Lower prices make it harder for companies to raise capital or refinance debt. That financial stress becomes a headline. The headline becomes part of the narrative, and the narrative reinforces the price decline. At a certain point, critics argue, stock price stops reflecting business reality and begins shaping it. Liquidity dries up. Vendors tighten terms. Employees leave. The decline feeds on itself. Overstock is one of the earliest and most cited examples of corporate conflict with short sellers. For years, company leadership publicly accused short sellers of manipulating the stock and overwhelming normal market dynamics. Those claims were disputed, but the outcome was clear. Persistent pressure, volatility, and long-term valuation damage despite ongoing operations. Regardless of who was right, Overstock became a template for a broader investor concern that once a company becomes a target, it can struggle to escape the cycle. GameStop revealed the opposite side of the same mechanics. Extremely high short interest created vulnerability. Retail investors noticed. And when buying pressure surged, short positions were forced to unwind. The result wasn't just a price spike, it exposed how leveraged and fragile certain short positions had become. GameStop didn't collapse, but it showed how extreme short exposure can destabilize markets in either direction. Nikola remains one of the most controversial examples. A high-profile short report accused the company of being an intricate fraud. The stock collapsed rapidly. Federal charges followed. Trevor Milton was later convicted of securities and wire fraud, a conviction he disputes, and received a presidential pardon. The Securities and Exchange Commission later dropped its case. Milton maintains that investor losses were caused by activist short sellers, not misconduct. Critics disagree. What isn't disputed is how quickly the market impact became irreversible. The MMTLP situation stands apart. MMTLP was tied to a spin-off into NextBridge Hydrocarbons, a private company. As the transition approached, trading was halted. Retail investors were unable to sell. Price discovery stopped. Positions were frozen. To this day, investors dispute whether all short positions were properly closed and reconciled before the halt. Unlike other cases, this wasn't just a loss in value. It was a loss of liquidity itself. Critics argue that in these scenarios, large institutional players benefit structurally. They can hedge risk, they can endure volatility, and they can profit from decline without facing the same constraints as retail investors. For them, volatility itself becomes an asset. For companies and retail holders, volatility becomes existential. Supporters of short selling argue it protects markets. Critics argue that under current rules, it can become a business model built on collapse. The question isn't whether short selling should exist. It's whether today's market structure prevents it from becoming something else entirely.